Hey folks, Meet Kevin has the capability right now to go down as the millennial, dare I say, Michael Burry, or even Bill Ackman, is the macro circumstance that he's making big bets on, if play out, are going to be unreal with the amount of attention he has on him right now, or is going to make his image look terrible as he might just be stirring FUD up. But I found a video where he's discussing exactly how he's playing this environment that I want to review. And if that's a conversation you appreciate, hit that like button. But before we watch that video, let's just talk about some of these macro events that are going to lead to some further instability or volatility in the stock market. And first and foremost, the federal fund rates, guys. We've had interest rates historically go down for the last 20 years. I mean, every single time we hit a hiccup in the road, the Fed just kind of puts the brake on interest rates. When after 2008, interest rates hit record lows, started coming back up between the 2018-2019 timeframe to only go right back down in the March 2020 crash. And now we don't have much of a choice as the Federal Reserve's hands are being tied. I don't think we're going to get nominal interest rate hikes. And you don't have to look far to figure out why, guys, because it's every aspect of the market driving up inflation to absolutely insane rates. And this is absolutely horrifying. You got to see this every time you go to the gas pump, right? Like literally in the last week alone, look at oil here, guys. I mean, it just keeps going up and up and up. And you can't have this consistently happening because not only costs more to drive, it costs more to get food, it costs more to do housing materials. So that's going to continue to impact us. This hasn't even hit the pumps yet. I mean, it's going to continue to, but let's talk about the food prices, right? Because a lot of this all correlates because the average 135.7 points in January 2022 is 1.5 points or 1.1% higher than the December 2021 food prices. And then we got to go to housing, right? Like when you look at housing right now, guys, this is in Ontario, by the way. So let me lower my head for you guys that are from the US. I don't think people understand that, like, you could have went back to April of 2020 and the average home in Ontario was worth under $600,000. Today, guys, and this only goes to December of 2021, is now worth $922,000 on average. And I can't go anywhere I live without homes being overbought at about 1.1, 1.2 million. So between all of these factors, I mean, you can't save fast enough to buy a house in this market where I particularly live. Most people, I mean, think about people that were in school, right? That had student loans, that were relying on restaurant jobs, that got laid off, restaurants shut down, and they said, don't worry, we're going to come back. Restaurants cleaned up. I mean, you know, they started collecting the people that got unemployed, took their stimulus, their jobs came back, and then all of a sudden, and again, primarily speaking from the Canadian Ontario standpoint, then as soon as they opened those jobs back up, you know, toward fall of last year, they just immediately cut them back off again going into the holiday season in the beginning of this year. So it's been a really rough ride for people that are trying to get by right now because like I said, when you look at all these price hikes and all this other stuff, like the dream of owning a home here, the dream of just having a comfortable life in this current environment is getting harder and harder and dwindling quick, right? So let's try to take this into frame and let's just listen to Meet Kevin real quick because he has some really interesting just points here that I want to have a discussion about.
Yeah, well, I believe we have a 60% chance that we're going to go into a recession. That's because I don't believe we're going to beat the GDP comps of last year. So we'll have a technical recession, 2 quarters of negative GDP. If that occurs at the same time as inflation is still high, we are going to have a freak out in financial markets because individuals are going to look at Jerome Powell and say, hey, come bail us out. Please bail us out. And he'll say, no, sorry, I have to keep tightening. So what should people do? In my opinion, you buy when the Federal Reserve U-turns. What I mean by that is they go accommodative or they stimulate again. That's the best time to buy. Really quickly, if you did that in the past and you bought when the Fed U-turned, you would have bought March 23rd, 2020, the bottom, December of 18, the Powell U-turn bottom, February of 2009, the bottom of the recession, Q1 of 03, the bottom of the dot-com bubble, and October of 1987, which was the bottom of the 87 crash. If you just buy when the Fed U-turns, you tend to do well. Wait for that time.
So this is really intriguing to me because basically he's playing off every single crash that we've ever had. And what's going to happen here is the Fed's probably going to get a little bit more aggressive than we could have hoped. And he's just planning to sit on his hands to when the Fed finally takes a break, clearly either stopping crazy interest rate hikes to start cooling the market back off, or basically just U-turning and just trying to re-stimulate the economy slightly. Because you got to remember, guys, even right now, the Fed is still pumping money into the economy. They should have raised interest rates literally a quarter or 2 quarters ago. So what we're going to get is an insane amount of volatility. Whether that means the stock market is going to go up or down is anyone's game. I don't make bets on that. I'm not as aggressive as Meet Kevin. I would rather ride the ups and downs. I'm going to be in this market for decades. But at the same time, I recognize the macro circumstances that we're living in. And of course, I want to hedge myself slightly, not to any major extent, just diversify the portfolio a bit to protect myself against insane volatility moves. And then on top of that, just put some cash aside, a little bit of an emergency fund for when the market drops. So instead of having a smaller percentage to invest on major dips, you have larger percentages. But that's not stopping me from buying stocks now either, because I'm reinvesting dividends. I talked about this many times before, but me, Kevin's become so divisive here, and it's a very like argumented conversation, because a lot of people are pissed the way he led his viewers down a certain path, and I would agree that's very bad for his image. We've talked about that on this channel. But when you listen to where he's coming from, some of the stuff that he's talking about actually, I think, plays a real fact in the current environment. So let's see how, all we can do, guys, is let's see how bad inflation gets. Let's just sit back, grab a bag of popcorn. There's no reason to be aggressive or freak out by this. Just be cautious and just, yeah, let's watch this. This is going to be the most entertaining time in the market since the March 2020 crash. I mean, it's going to be different, to say the least. But stay cool, stay awesome, and let me know what you think in that comment section below.